Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the Through the Noise podcast. We released our Q4 market outlook last week, and yesterday I spoke to Rajat about the macroeconomic outlook, and today I want to talk about how an income investor might approach the current investment climate. So as regular readers will be aware, we have our 3 R's strategy in our Q4 outlook, and they are rebalance towards high quality assets, risk manage our portfolios, and rotate into income assets. So it's the latter that we're going to be talking about today. To do this, I have asked Audrey Go, who runs the CIO office's asset allocation team, to join me. Similar to most asset classes, income investments have lost a significant value this year. They have outperformed global equities and bonds, which are obviously down over 20%. But Audrey will outline our outlook to income investing and which areas in particular we think will outperform. So Audrey, as we've spoken about many times, it clearly has been a very challenging 9 months or so for investors. We mentioned that bonds and equities are sharply lower. Income strategies have clearly not been spared as well, although they have held up better than the sort of balanced or more growth-focused allocations. Can you explain why this might be the case and our outlook on income investing strategies going forward?
Well, thanks, Steve. If you look at our multi-asset income allocation today, they now yield over 7% as central banks have continued to hike rates to bring inflation down globally. In terms of performance, fixed income asset class have fared worse compared to equity income or dividend income, with global bonds down about 20% compared to around 14% for global dividend equities. And as a result, if we look at the universe today, more than 59% of the bonds globally now offer yields in excess of 4% versus just 3% of bonds from a year ago. And given our multi-asset income allocation holds a blend between fixed income assets, dividend equities, as well as a small proportion to non-core assets, it has basically fared better compared to global bonds and a balanced growth allocation. So in terms of expectation, we do expect our diversified multi-asset income strategy to outperform a balanced allocation over the next 6 to 12 months. With the 7% yield on offer today, it is clearly looking quite attractive. And given rising risk of a recession and the potential for a sharp growth slowdown, strategies which produce real cash flow, such as diversified multi-asset income, are being increasingly favored over a balanced and purely growth-focused allocation. And income will be an important source of returns from a total return perspective, in our opinion.
Okay, so in our Q4 Outlook publication, we talked about the preference to add to bonds at the expense of equities. Is the same true in an income space?
So we've also added to fixed income assets within our multi-asset income allocation. We see rising value in bonds with yields in developed market investment grade bonds over 3.7%, the highest since 2010. And US real yields have also risen quite sharply to almost 1%, which is one of the sharpest increase that we have seen in recent history. Our view is that the Fed is likely to remain hawkish in the near term. But having said that, with the strong convergence that we have seen in terms of market expectation to the Fed's forecast, this will also suggest to us that the worst of bond yield increase is also likely behind us. So we like bonds with a high quality tilt, and we have added to developed market investment grade corporate bonds as well as Asia US dollar bond this month. So if we look at US dollar bond, the yields are quite attractive. More than 85% of the bonds comes from investment grade issuers, and they also have relatively lower volatility compared to US government bonds. And let's also not forget that Asian US dollar bonds will also benefit from continued monetary policy easing in China. Another area in the bond space that we like is floating rate notes, which is one way to hedge against rising inflation. Yields on this asset class are relatively decent, and they also come with much lower interest rate risk. Plus, default rates also looks quite benign.
Okay, so let's move on to equities. So obviously, the benefits of having equities in any portfolio is the potential growth opportunities, right? So what's your perspective on high dividend yielding equities in an income portfolio today?
So we've pared back slightly on our allocation to dividend income, given what I mentioned earlier about rising recession risk, as well as more attractive yields in the fixed income asset space. But having said that, we still do hold a significant amount of just over 50% of dividend equities within our income allocation. If you look at dividend equities, they have typically historically outperformed during high inflation regimes and when global growth is slowing. But having said that, there also exists the potential for a large drawdown in the event of a recession. Therefore, we're basically taken this opportunity to par back on some of our allocation in dividend income to benchmark allocations tactically. Over the long term, though, dividend income still offers a greater probability of delivering positive inflation-adjusted return compared to bonds or even cash in our view. However, unlike the income in bonds or in cash, if you look at dividend income, they actually are from companies and they have the ability to raise dividend income as their profitability grows, and therefore it does offer a decent long-term hedge against inflation.
Yeah, and that inflation concern is still very central to what people are worried about today, right? So maybe just finally, you mentioned non-core assets earlier. Can you just give people a sense of how we think about non-core assets, what they are, and how they are positioned within your income allocation?
So non-core income are hybrid assets with either bond-like or equity-like characteristics. For example, in subordinated financials, covered calls, as well as REITs. And within our multi-asset income allocation, we do have a 20% allocation to non-core assets. And they are basically included to supplement income as well as capital potential. So year to date so far, these non-core assets have also declined given the rise in rates that we have seen year to date. If you look at subordinated financial bonds, they are basically sold off in sympathy with much higher rising yields in Europe. And this asset class is predominantly made up by European banks. And at 11% yield today, it does look quite attractive. And our expectation is, coupon write-down related risk or even coupon cancellation risk are relatively low given that capitalization for most European banks actually remains quite robust. The other non-core assets will include the likes of REITs as well as covered calls. And these assets have traditionally been quite resilient during inflationary environment. And we also view them as relatively attractive for income as well as capital appreciation potential.
Okay, that's all we have time for today. Thanks so much, Audrey, for taking time out of your day. Obviously, rotating into income assets is a core theme in our investment strategy for the fourth quarter, and therefore it's really interesting to see how you think about this area. Meanwhile, thank you, listeners, for listening in. And remember that if you would like more details on our views, then please do stop by our LinkedIn page or reach out to your relationship manager for a more detailed set of reports. We'll end there. In the meantime, please take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.